Gold at $5,000 isn't a bubble, it's a warning. Because bubbles come with euphoria. This move comes with disbelief. Retail is selling, central banks are buying, paper contracts are expanding, physical metal is tightening. And when those two realities finally collide, price doesn't drift. It reprices. Gold is trading near historic highs, and yet the data doesn't resemble a bubble. It looks like repositioning. Start with ETF flows. In true speculative blow-offs, price and ETF inflows move together aggressively. Think 2020, think 2011. Today, price has broken out, but global gold ETF holdings remain well below prior peaks. Western funds have been net sellers into strength. That is not mania behavior. Retail participation tells the same story. Household allocation to gold in the U.S. remains a small single-digit percentage of financial assets. Compare that to 2021 tech, where retail options volumes exploded, or 2006 housing, when speculative property flipping became cultural. We don't see leverage spikes. We don't see parabolic margin expansion. We see hesitation. And that's the psychological tension. Price is signaling urgency. Sentiment surveys remain lukewarm. Financial media still frames the move as overextended. True bubbles require broad enthusiasm, narrative dominance, cocktail party validation. Gold has none of that. Instead, central banks are buying at record pace. Emerging market sovereigns are diversifying reserves. Meanwhile, Western institutional portfolios remain structurally underweight hard assets. That divergence matters. When price rises without retail euphoria, it suggests accumulation beneath the surface. Not excess, not froth, structural reallocation. And if positioning is still light while sovereign demand accelerates, then the move we're witnessing may not be the end of speculation, but the beginning of repricing. Gold's price is discovered in New York, but gold itself is moving in Shanghai, Istanbul, and central bank vaults. On the COMEX, open interest routinely represents tens of millions of ounces, often more than 20 times the amount of registered, deliverable gold sitting in warehouse stocks. In other words, for every ounce available for delivery, there are dozens of paper claims trading against it. Most contracts are cash-settled or rolled. Delivery is the exception, not the rule. CME futures volume dominates daily price action. Algorithmic flows, hedge fund positioning, and macro hedging drive short-term moves. Yet, simultaneously, physical offtake in Asia has remained persistent. Premiums in Shanghai frequently signal tight local supply. Central banks are accumulating at the fastest pace in decades, removing metal from the float entirely. This is the fault line. The global benchmark price is derivative-driven, synthetic supply meeting synthetic demand. But the underlying asset is being steadily absorbed by sovereign actors who are not trading quarterly momentum. They are reallocating reserves. Layer on the macro backdrop, sovereign debt expanding, fiscal deficits entrenched, and the dollar increasingly used as a geopolitical lever. Reserve managers are responding accordingly. This isn't a prediction of collapse, it's an observation of divergence. Financial gold trades by contract, monetary gold moves by delivery, and when those two systems drift too far apart, fragility doesn't announce itself. It builds quietly beneath the surface. The real pressure point isn't the stock market, it's the Treasury market. U.S. debt has surpassed $34 trillion, and with higher policy rates, the cost of servicing that debt is compounding rapidly. Interest expense is now one of the fastest-growing line items in the federal budget. At the same time, Treasury issuance is accelerating to fund persistent fiscal deficits. More supply, higher rollover costs, tighter liquidity. The Federal Reserve is boxed in. If it keeps rates elevated to defend the dollar and suppress inflation expectations, Treasury borrowing costs rise further, stressing duration-sensitive buyers and regional banks still carrying unrealized bond losses. If it eases policy to relieve pressure on the bond market, liquidity expands and real yields compress, historically supportive for gold. The constraint is mathematical, not ideological. Primary dealers are absorbing increasing shares of issuance. Foreign demand has plateaued relative to prior decades. Meanwhile, central banks are accumulating gold as neutral reserve collateral, outside the dollar system. Even more telling, Bitcoin has been rising alongside gold. That's not inflation trade behavior. That's a signal of monetary distrust, a hedge against policy instability. The Fed's choices are narrowing: protect the currency or protect the Treasury market, tighten into a debt wall or ease into structural debasement. Either path injects volatility into the world's reserve asset. And in that environment, neutral stores of value stop being optional allocations. They become balance sheet strategy. Commitment of traders' data tells a very different story than price headlines. In prior peaks, 2011, 2020, managed money net length surged to extremes. Hedge funds were aggressively long, commercials heavily short, and positioning was crowded. Today, speculative length is elevated but nowhere near historic blow-off levels. Commercial hedgers, often bullion banks, are not positioned defensively to the same degree seen at major tops. That matters. Crowded trades collapse under their own weight. Moderately extended trades correct, consolidate, and continue. Now look at the gold-silver ratio. It remains historically high relative to long-term averages, signaling that silver has lagged the monetary move. In true late-cycle metals euphoria, that ratio compresses aggressively as capital rotates down the risk curve into higher beta exposure. We're not there. Technically, parabolic advances require digestion. Even structural bull markets experience violent 10 to 15% pullbacks. Liquidity thins during certain futures sessions. Volatility expands. Weak hands get flushed. Bullion banks understand this rhythm. Exposure is managed, stops cluster. Thin liquidity windows can exaggerate downside air pockets. The tension isn't whether gold is in a bull market. It's whether participants can survive its volatility. This is where discipline separates from emotion. Chasing vertical price invites pain. Strategic allocation during consolidation builds positioning strength. The macro regime may be shifting, but timing within that regime still punishes impatience. The macro path from here splits into two very different realities. Scenario 1, disinflation reset. Inflation continues cooling. Growth slows decisively. Real yields rise as nominal rates stay restrictive while price pressures fade. Liquidity tightens further. A hard recession hits. Commodity demand contracts. Credit spreads widen. In that environment, gold doesn't collapse structurally, but it corrects sharply. Elevated prices meet positive real yields. Capital rotates back into cash and short-duration assets, the dollar firms. Gold enters a deep consolidation, base building while leverage clears out. Now the alternative. Scenario 2. Currency repricing. Treasury rollover stress intensifies. Auctions tail. Primary dealers strain under supply. Fiscal deficits remain entrenched. The Federal Reserve, implicitly or explicitly, shifts toward liquidity support. Balance sheet expansion resumes. Real yields compress, not because growth is strong, but because debt math demands accommodation. Here, gold transitions from hedge to anchor, not an inflation trade, a monetary credibility trade. These paths are mutually exclusive in timing. One requires sustained tight liquidity. The other requires policy capitulation. The institutional tells will be visible. Treasury auction demand metrics, changes in the Fed's balance sheet trajectory, central bank gold accumulation trends, and the behavior of the dollar index during stress events. This is the binary, a disinflationary purge, or a structural repricing of currency risk. Positioning ahead of that resolution will define performance. Here's the binary that matters. Is gold approaching speculative excess, or is it quietly discounting a sovereign balance sheet reset? Because $5,000 per ounce in that context is either the final blow-off top, or it's the floor of a new monetary regime. Start with participation. Retail allocation to gold remains historically low. There is no broad public enthusiasm, no leverage frenzy, no cultural obsession. True bubbles require mass belief. This move has climbed through skepticism, not euphoria. Second, central banks continue accumulating physical metal at a historic pace. Sovereign vaults are absorbing supply while futures contracts still dominate price discovery. The derivative tail continues to wag the physical dog, but the underlying float is tightening. Monetary gold is migrating from speculative hands to strategic balance sheets. Third, Federal Reserve policy constraints matter. Debt servicing costs, Treasury issuance, and financial stability risks structurally limit how high real yields can rise over sustained periods. Liquidity cycles may oscillate, but the ceiling on tightness is increasingly visible. So watch the signals. Watch for renewed liquidity injections. Watch Treasury auction stress. Watch physical delivery premiums in Asia. Watch how gold behaves relative to equities and credit during volatility. If this were a bubble, it would feel louder. It would feel crowded. Instead, it feels early, uneasy, under-owned. And quiet bubbles don't typically implode. They expand until the pricing mechanism itself begins to change.